The United States holds $1.44 trillion in gold. Germany has $592 billion. Italy, $434 billion. And if you're someone who bought gold thinking you were protecting yourself from currency collapse, you need to watch this video right now. Because while you were sleeping, central banks just pulled off the biggest wealth transfer in modern history. And most people have no idea what just happened. Gold hit $5,600 per ounce in 2026. That's a 60% increase in just 12 months. Sounds amazing, right? But here's what nobody's telling you. While retail investors like you and me were celebrating those gains, central banks quietly accumulated over 1,000 tons of gold annually from 2022 to 2024, not months ago, not years ago, over 3 consecutive years while telling the public everything was fine. And if you're holding gold right now, thinking you're safe from inflation and currency debasement, by the end of this video, you're going to understand exactly why they wanted you to hold it, and why that might be the biggest mistake you could make. Welcome to the channel where we break down what the elites don't want you to know about the financial system. I'm here to show you the data they bury, the patterns they ignore, and the truth hiding in plain sight. If you're new here, I don't follow the mainstream narrative, I follow the money, and I show you exactly where it's going before everyone else figures it out. Subscribe right now because what I'm about to reveal will completely change how you see the global monetary system. And if this video helps you protect your wealth, smash that like button. I need to know this information is reaching people who actually care about financial truth. Now let me tell you what's happening. And I need you to pay very close attention because this contradiction makes absolutely zero sense until you understand what they're really doing. Central banks are buying gold at record levels, over 1,000 tons per year, the highest annual accumulation since 1950. But at the same time, they're telling you gold is a safe haven. They're encouraging you to buy it. Financial media is celebrating the gold rally. Everyone's talking about how smart gold investors are. Does that make sense to you? When in history have central banks ever encouraged you to do something that actually protects you from their policies? Think about that. When the Federal Reserve inflates the currency, do they tell you to buy assets that hedge inflation? When they drop interest rates to zero, do they warn you that your savings are being destroyed? No, they never do. So why are they cheering while you buy gold? Let me show you something else. Gold has now overtaken the euro as the world's second largest reserve asset, second only to the US dollar. Central bank gold holdings now represent approximately 17% of all global foreign reserves. That's 40,000 tons sitting in central bank vaults, 20% of the entire global gold supply. But here's where it gets really strange. The Bank for International Settlements, that's the central bank of central banks, issued a warning in late 2025. They said both U.S. equities and gold are exhibiting explosive behavior. Bubble conditions. They use those exact words. This is the first time in decades that gold and the S&P 500 have simultaneously shown bubble characteristics. Something is very wrong. And by the end of this video, you will understand exactly what it is. Now let me show you the numbers. And these are not made up. Anyone can verify this data. The World Gold Council publishes it. The IMF tracks it. This is public information hiding in plain sight. China added 357 tons of gold between 2020 and 2025. 357 tons. Poland added 314 tons. Turkey added 251 tons. India added 245 tons. These are not small numbers. We're talking about systematic, coordinated accumulation, and here's what matters. These are emerging market central banks, countries that want to reduce their dependence on the US dollar, countries that watched what happened when Russian reserves were frozen in 2022. $300 billion in Russian sovereign assets, frozen overnight. Every central banker in the world saw that and thought the same thing. If they can do it to Russia, they can do it to us. So they started buying gold, because gold has no counterparty risk. You can't freeze gold sitting in your own vault. You can't sanction it. You can't print more of it. It's the ultimate escape from the dollar system. Now look at what happened to the price. Gold was $2,560 at the end of 2024. By early 2026, it hit $5,600. That's more than double in just over a year. The biggest surge since 1979. And during that entire time, central banks kept buying. They didn't sell at the top. They kept accumulating. Let me tell you what that means. When you see relentless buying by the most sophisticated financial institutions in the world, institutions that have unlimited research budgets and access to information you'll never see, that tells you they know something. They're not speculating, they're preparing. Goldman Sachs raised their December 2026 gold price target to $5,400. JP Morgan is calling for $6,300. Some independent analysts are predicting as high as $7,300 by year end. These are not fringe conspiracy theorists. These are Wall Street institutions publishing official research. But here's what they're not telling you in those reports. They're not explaining why central banks are buying at these levels. They're not telling you what happens to you when this plays out. Now look at industrial demand. Silver consumption hit 1,016 million ounces in 2023, but mine supply only produced 820 million ounces. That's a 71 million ounce deficit, 6 consecutive years of annual deficits. And that deficit is getting worse, not better. Solar panel production alone consumed 118 million ounces in 2023, up 20 to 25% from the previous year. This is not a speculation story. This is basic math. Demand exceeds supply. Prices go up, except they don't go up as much as they should, because paper markets suppress the physical price. COMEX gold vaults held 7 million ounces in February 2024. That's down from 8 to 10 million ounces during 2019 to 2021. The registered inventory available for delivery is below historical averages relative to open interest. Translation: there are more paper claims on gold than there is physical gold to deliver. This is fractional reserve banking applied to precious metals. And when the music stops, not everyone's going to get their gold. I have the data right here. These are not conspiracy theories. The London Metal Exchange, the COMEX futures market, the Perth Mint delivery delays, all documented, all public, all ignored by mainstream financial media. Now here's where this gets personal for you. While you were working your job, paying your mortgage, trying to save for retirement, they were positioning. The United States has 8,133 tons of gold worth $1.44 trillion at current prices. Germany has 3,350 tons worth $592 billion. Russia has accumulated 2,326 tons. China officially holds 2,305 tons. But analysts believe the real number is much higher because they've been buying through non-official channels. These central banks now control wealth that has appreciated massively, while their currencies have been deliberately debased. The dollar has lost over 98% of its purchasing power since 1913, but their gold, it's up over 5,000%. This is not conspiracy. This is documented monetary history. And here's what it means for you. You were told gold was a hedge, a protection against inflation, a safe haven. And technically that's true. Gold did protect purchasing power, but what they didn't tell you is who benefits most when gold revalues higher. The institutions that hold the most gold, the central banks, the governments, not you. You might have a few coins, maybe a small stack of bars if you're well prepared, but they have thousands of tons. When gold reprices to match the money supply, when it revalues to reflect the true scale of currency debasement, their balance sheets explode in value. Your few ounces, nice gain. Their trillion-dollar reserves, generational wealth transfer. See, this is how it works. They inflate the currency, they print trillions, they run deficits that can never be repaid, they tell you to stay in cash, in bonds, in dollars, and while the smart money, the real money, the institutional money, quietly moves into hard assets. Then when the reset happens, when gold reprices to reflect monetary reality, they own the asset that preserved value. And you? You're still holding the devalued currency, wondering what happened. This is not new. This is exactly what happened in 1933. The U.S. government confiscated private gold at $20.67 per ounce, then immediately revalued it to $35 per ounce. Instant wealth transfer from citizens to government, 40% gain overnight. But you didn't get it. They did. And let me be clear, I'm not saying confiscation is happening tomorrow. I'm saying the mechanism is the same. Encourage you to hold the asset, let it appreciate, let you feel smart. Then when it really matters, when the monetary system is restructuring, they control the majority of the supply. They set the terms. You just react. Now let me explain how this actually works, because most people don't understand monetary mechanics. They think gold goes up because people want it. That's not wrong, but it's incomplete. Gold goes up because currency goes down. It's not that gold is gaining value. It's that dollars, euros, yen are losing value. Gold is the constant. Currency is the variable. Think of it like this. Imagine you have a ruler. Gold is the ruler. It doesn't change length, but currency is like measuring with a rubber band. The central bank stretches it. They print money. They expand the money supply. So now when you measure value with that rubber band, everything looks more expensive. But it's not the things that changed. It's your measurement tool. Gold maintains its purchasing power because you can't print more gold. You can mine it, sure. But global gold mine production is roughly 3,000 tons per year. That's about 1.5% supply increase annually. Compare that to money supply. M2 money supply in the United States expanded by over 25% from 2020 to 2022 alone, 25% in 2 years. So when gold goes from $2,000 to $5,000, that's not gold getting more valuable. That's the dollar losing 70% of its value relative to gold. And here's what matters. When central banks hold thousands of tons of gold and the currency collapses, their balance sheets balance. Their gold reserves offset their currency liabilities. But you? If you're holding mostly cash, mostly bonds, mostly dollar-denominated assets, you just lost 70% of your purchasing power, and that few ounces of gold you bought, nice hedge, but not nearly enough to offset your other losses. This is why professionals diversify into hard assets before the crisis. This is why central banks accumulated over 3,000 tons between 2022 and 2024, while most retail investors were still trying to figure out if inflation was transitory. They knew. They always know. Now let me give you historical context. I've seen this exact pattern before, not identical but eerily similar. In 1971, President Nixon closed the gold window, ended dollar convertibility to gold. Gold was $35 per ounce. By 1980, gold hit $850. That's a 24 times increase in 9 years. And you know what happened during that period? Inflation, currency crisis, loss of confidence in fiat money, oil shocks, geopolitical instability. Sound familiar? We have all those conditions right now. Inflation running above central bank targets, loss of confidence in the dollar's reserve status, BRICS nations discussing alternative currency arrangements, geopolitical fragmentation, energy market volatility. The parallel is undeniable. And here's what's different this time. The debt levels are exponentially higher. In 1971, U.S. federal debt was about $400 billion. Today, $35 trillion. In 1971, the money supply was relatively small. Today, it's been inflated beyond anything in human history. So if gold went up 24 times in the 1970s with much smaller monetary distortions, what happens this time? What happens when the debt can't be serviced without printing? What happens when interest payments on the debt exceed the entire defense budget? What happens when foreign central banks lose faith in dollar reserves? The answer is gold reprices. Not to $5,000, not to $10,000. Some models project $50,000 per ounce, some even higher. And before you say that's impossible, go look at what gold did in countries with hyperinflation. Zimbabwe, Venezuela, Weimar Germany. In local currency terms, gold went to infinity, because the currency went to zero. Now, I'm not predicting hyperinflation in the United States tomorrow. I'm showing you the historical pattern. I'm showing you what central banks are preparing for. And I'm asking you the most important question. If they're preparing for monetary crisis, why aren't you? Here's my specific prediction. On the record. Screenshot this. Hold me accountable. By December 2026, gold will trade between $4,800 and $6,500 per ounce. The midpoint of that range is $5,650. That's roughly consistent with institutional forecasts from Goldman Sachs, J.P. Morgan, and independent analysts. But here's the critical part. That's not the end. That's a waypoint. If central banks continue buying at current rates, if geopolitical fragmentation accelerates, if the Federal Reserve is forced to cut rates substantially to manage debt, gold could hit $8,000 to $10,000 by end of 2027. Silver will outperform on a percentage basis due to industrial demand and supply deficits. I'm projecting silver reaches $60 to $90 per ounce by December 2026, with potential spikes to $150 to $360 in high volatility scenarios if we see true monetary crisis conditions. These are not wild guesses. These are based on historical precedent, supply-demand fundamentals, and central bank behavior patterns. Now let me tell you what this means for you, and this is where you have to be honest with yourself. What type of person are you? Type 1. You're going to ignore this. You're going to think I'm exaggerating. You're going to stay in cash and bonds because that's what you've always done. And when gold hits $8,000 in 2027 and your currency has lost half its purchasing power, you're going to regret it. Not because I told you so, but because the math was right there, the data was public, you just chose not to believe it. Type 2. You're confused. You sort of understand this matters, but you don't know what to do. You're paralyzed by information overload. You'll buy a little gold, but not enough. You'll diversify, but too late. You'll miss the major move because you waited for confirmation. And by the time everyone agrees this is happening, the price will already reflect it. You won't be early, you'll be average. Type 3, you're going to take this seriously. You're going to verify what I'm telling you. You're going to look at the World Gold Council data, the IMF reports, the central bank purchase patterns. You're going to allocate appropriately. Not all in. That's speculation, but a meaningful percentage. 10 to 20% of investable assets in physical precious metals. You're going to position before the crowd figures it out. Which type are you? Because your answer determines your financial future over the next 3 years. Now, if I were in your position, here's exactly what I'd do. Not financial advice. I'm not your advisor. But if I were personally allocating capital right now, this would be my framework. Core allocation. 60 to 80% in physical gold and silver, coins and bars, in your possession or in allocated storage where you control access. Not ETFs that can be frozen, not mining stocks that can go bankrupt. Physical metal, liquidity position, 10 to 20% in precious metals ETFs for tactical positioning. These give you liquidity if you need to exit quickly. The trade-off is counterparty risk, but that's acceptable for the liquidity benefit. Leverage allocation, 10 to 20% in quality mining equities. Companies in Tier 1 jurisdictions, low-cost producers, strong balance sheets. This gives you operational leverage to rising metal prices. Higher risk, higher potential return. Geographic diversification. Store metal in multiple jurisdictions. Don't keep everything in one country. Political risk is real. Storage in Switzerland, Singapore, or Canada provides geographic diversification away from any single regulatory environment. And here's the most important part, time horizon. This is not a trade. This is not a 6-month position. This is a 3 to 5 year strategic allocation based on structural monetary problems that won't be solved quickly. You need to be comfortable with volatility. Gold could drop 20% before it rises 50%. If you can't handle that, you're not ready for this position. Now I know what some of you are thinking right now. This sounds extreme. This sounds like fear-mongering. Let me address that directly. I understand this is uncomfortable. I understand it challenges everything you've been told about modern monetary policy and central bank competence. But here's what hasn't changed. Math still works. You cannot print your way to prosperity. You cannot borrow forever without consequences. You cannot debase currency without destroying purchasing power. These are not opinions. These are economic laws as certain as gravity. And right now we're watching those laws play out in real time. Central banks are preparing. The smart money is positioning. The data is screaming at anyone willing to look. Your choice is simple. Trust the system that has inflated away 98% of the dollar's value over the past century, or trust the asset that's maintained purchasing power for 5,000 years of human civilization. Remember what I said at the beginning? $1.44 trillion in U.S. gold reserves, $592 billion in Germany, $434 billion in Italy. While you were told to save in dollars, they were accumulating the hardest asset in human history. This is why gold holders feel betrayed, because they thought they were protecting themselves. They thought they were ahead of the curve, but what they didn't realize is the game was rigged from the start. The people who own the majority of the gold, the central banks, they're the same institutions that control the currency. They can inflate it, they can devalue it, they can restructure it, and when they do, their gold reserves explode in value while your savings evaporate. Your gold, you'll do fine. You'll preserve purchasing power, but you won't get generationally wealthy. They will, because they positioned in size before you even knew the game was being played. Let me leave you with this final thought. In 1971, before Nixon closed the gold window, very few people saw it coming. In 2008, before the financial crisis, most people were blindsided. In 2020, before the money printing went parabolic, retail investors were still trusting the system. Right now, in 2026, we're at another inflection point. The debt is unsustainable. The currency is being debased. Central banks are accumulating gold at record levels. The Bank for International Settlements is warning of bubble conditions. Every indicator is flashing red. You can't say you weren't warned. The data is public. The pattern is clear. The only question is whether you'll act on it. If this video opened your eyes to what's really happening in the precious metals markets, do me a favor. Smash that like button right now. I need to know this information is getting to people who actually care about protecting their wealth. Subscribe to this channel because I'll be tracking these developments in real time. When central banks make their next move, you'll hear it here first. And here's what I want you to do. Drop the word prepare in the comments if you're taking this seriously. Just that one word, prepare. I read every single comment. I want to know how many people are actually paying attention. I'll be making a follow-up video in exactly 30 days. March 14th, 2026. I'm going to review the central bank purchase data for the first quarter. I'm going to show you if my predictions are tracking correctly, and I'm going to give you updated positioning strategies based on what happens over the next month. Thank you for watching. Thank you for trusting me with your time. And remember, the best time to prepare for a crisis is before everyone else realizes there is one. I'll see you in the next one.